Candlestick patterns play a crucial role in trading, serving as a valuable tool for understanding market sentiments and predicting future price movements. These patterns, represented by the graphical depiction of the opening, closing, high, and low prices within a specific time frame, offer insights into the emotional state of the market. Recognizing and interpreting these patterns correctly can provide traders with a competitive edge, identifying potential market reversals or continuation patterns before they occur. It is important for traders to engage in ongoing learning and to remain adaptable in using candlestick patterns. The financial markets are dynamic, and what works today might not work tomorrow. Thus, traders should continuously hone their skills, seeking out new knowledge and adapting their strategies to keep pace with market changes. I encourage traders to explore the use of candlestick patterns in their trading practice. Begin with the basic single candlestick patterns, focusing on mastering these before moving on to more complex formations. Remember, success in trading requires patience and consistent practice. By dedicating time to study and understand how these patterns work in various market conditions, traders can develop a nuanced approach to trading that leverages the predictive power of candlestick patterns. Candlestick patterns are a fundamental part of technical analysis in the financial markets. They offer a visual representation of price movements within a given time frame, capturing the market's opening, closing, high, and low prices. These patterns can provide insights into market sentiment and potential price movements, making them a valuable tool for traders and investors. Among the various candlestick patterns, the doji stands out as a unique indicator of market indecision. Characterized by its narrow body, the doji forms when a market's open and close prices are nearly the same, resulting in a candlestick that looks like a cross or a plus sign. This pattern signifies a balance between buying and selling pressures, suggesting a moment of hesitation among participants and the possibility of a market turn or continuation. The doji's relevance in technical analysis cannot be understated. It appears in different market contexts and can signal potential reversals or continuations based on its position within a trend and in relation to other candlesticks. Its simplicity and the potent information it conveys about market sentiment make the doji a critical pattern for those utilizing candlestick charts in their market analysis. The doji is a pivotal candlestick pattern found in technical analysis of financial markets. Its appearance is unique, characterized by a small or non-existent body, indicating that the opening and closing prices are either identical or very close to each other. What sets the doji apart from other candlestick patterns is this very feature of having a near equal open and close, which visually manifests as a thin line. This pattern represents market indecision, where neither buyers nor sellers have gained significant ground over the course of the trading period. The doji can appear in various chart contexts, signaling potential reversals or continuations in the market, depending on preceding trends and future confirmations. When we delve into visual examples, imagine a standard candlestick chart where each candle represents a specific time frame of trading activity. In a bullish trend, a doji may signal that buying momentum is waning, suggesting a potential reversal to a bearish trend. Conversely, in a bearish trend, a doji can indicate that selling pressure is diminishing, hinting at a possible shift to a bullish trend. There are several types of doji patterns, each with subtle differences in appearance, but all sharing the characteristic slim line that suggests equilibrium between buyers and sellers. For instance, a long-legged doji has longer shadows or wicks that extend both above and below the body, reflecting greater indecision and volatility. Another variant, the dragonfly doji, has a long lower shadow and no upper shadow, suggesting that sellers pushed the price down, but buyers managed to pull it back up to the open. Understanding the doji within different chart contexts requires noting its position in relation to previous trend movements and candlestick formations. For example, a doji that occurs after a series of strong bullish candles may hint at a forthcoming bearish reversal. Meanwhile, a doji that appears during a period of consolidation may not signify a clear directional change, but rather the continuation of market indecision. The importance of context cannot be overstated. Traders often wait for additional confirmation following a doji pattern to gauge the market's direction. This confirmation could come in the form of a subsequent candlestick closing in the direction opposite to the preceding trend, thus offering a clearer signal of market sentiment shift. In summary, the doji stands out in technical analysis for its unique appearance and the valuable market insight it provides. By signaling a moment of equilibrium where neither bulls nor bears dominate, it draws attention to potential shifts in market momentum, guiding traders through the complexities of decision-making in financial markets. To identify a doji on a chart, one should look for its distinctive characteristics, which serve as indicators of market indecision. A doji is recognized by its small or practically non-existent body, signified by a closing price that is almost identical to its opening price. This results in a candlestick that appears as a thin line. The length of the wicks or shadows extending from the body can vary, but they are typically longer than the body, reflecting the difference between the high and low prices during the trading session. A typical doji formation is one where the body appears as a thin horizontal line situated in the middle of two longer vertical lines, resembling a cross or plus sign. This indicates that though there was volatility within the trading period, buyers and sellers were equally matched, leading the session to close near its opening price. Variations of the doji pattern can include situations where the body is closer to the high or low of the session, known as a gravestone or dragonfly doji, respectively. These variations signal differing levels of indecision and potential reversals in market trends. Dojis can occur in any market condition, whether in an uptrend, downtrend, or sideways market. Identifying a doji in an uptrend might suggest a potential reversal or a pause in the upward momentum, indicating that buyers are losing control. Conversely, a doji appearing in a downtrend could imply that sellers are losing their grip, potentially heralding a reversal to the upside. Visualizing these patterns, imagine a chart during a bullish trend with several long-bodied green candles indicating strong buying pressure. Suddenly, a candle with a minuscule body appears, overshadowed by its wicks at both ends. This is a doji emerging amidst the dominance of either buyers or sellers to signal that the tide may be turning, or at least that the market is taking a moment to catch its breath and reassess. In conclusion, a doji represents a moment of equilibrium where neither buyers nor sellers have definitive control, making it an essential pattern for traders and investors to recognize. Its identification relies on scrutinizing the size of the candlestick's body and the extent of its wicks, set against the backdrop of ongoing market conditions to gauge potential shifts in market sentiment. The doji is a distinct pattern in the realm of technical analysis, primarily recognized for its unique appearance on a candlestick chart. This pattern occurs when a security's open and close prices are virtually the same, resulting in a cross-like or plus sign shape, signifying equilibrium between buyers and sellers. It is a manifestation of indecision in the market, where neither bulls, buyers, nor bears, sellers manage to gain control, leading to an impasse. The presence of a doji indicates a tug of war between buyers and sellers. At the start of the trading session, buyers may push prices higher, reflecting optimism. Conversely, sellers might pull prices down, showcasing pessimism. When these forces are balanced, the session closes at or near its opening price, forming a doji. This equilibrium suggests uncertainty and caution among participants, often signaling a potential pause or reversal in the ongoing trend. Historical examples confirm the significance of dojis in signaling shifts in market sentiment. For instance, during a sustained uptrend, the appearance of a doji can imply that buyers are losing steam and sellers are starting to resist, hinting at a possible trend reversal. Similarly, in a downtrend, a doji might indicate that selling pressure is waning and a bottom could be near, pointing towards a likely bullish reversal. These points of indecision mark critical junctures where investors reassess their positions and strategies, often leading to significant changes in market direction. For example, ahead of major market turns, such as before the dot-com bubble burst or prior to the rapid recovery phases following market corrections, dojis have been observed. These patterns serve as valuable indicators for analysts and traders, suggesting a time to be cautious or to prepare for upcoming movements. In essence, the doji is more than just a pattern. It is a narrative of market sentiment, embodying moments of hesitation and shifts in momentum. Its simplicity in appearance belies the complex dynamics of market psychology it represents, making it a staple tool in the arsenal of those who navigate the financial markets. When examining the Doji candlestick pattern in the context of financial charts, it is important to understand that its significance hinges greatly on the surrounding market conditions. The Doji pattern, characterized by its cross-like appearance where the opening and closing prices are nearly equal, often symbolizes a level of indecision within the market. However, whether it signals a continuation of the current trend or a forthcoming reversal can depend on various factors. Firstly, a doji found in an uptrend may suggest that buyers are losing momentum, and a reversal could be on the horizon. Imagine a scenario where after a long period of bullish momentum, marked by rising prices and strong buying activity, a doji appears at the peak. This indicates that the buying pressure is starting to wane as sellers begin to enter the market with more force, potentially leading to a change in direction. Conversely, a doji occurring in a downtrend suggests that selling pressure may be diminishing, which could point to a reversal to an upward trend. In this case, after a sustained period of falling prices characterized by strong selling, the appearance of a doji signals that sellers are losing control and buyers may be preparing to take over, potentially driving prices up. However, context is critical. A doji found during a period of consolidation where the market is largely moving sideways may not have a significant impact on future price movements. Here, the doji merely confirms the current indecision and lack of a clear trend. Chart patterns play a crucial role in interpreting the doji. For example, a doji that forms part of a bullish reversal pattern, such as a bullish engulfing pattern or a morning star setup, can offer a strong signal that the downtrend may be coming to an end. On the other hand, a doji that is part of a bearish reversal pattern, like a bearish engulfing or evening star pattern, can indicate the end of an uptrend. In summary, while the doji is a powerful symbol of market indecision, its significance is highly dependent on its context within prevailing market trends and other chart patterns. Whether it signifies a continuation or a reversal can only be determined by carefully analyzing the market conditions surrounding its appearance. When analyzing a doji, which is a candlestick pattern representing indecision in the market, it is crucial to consider additional indicators to interpret its significance accurately. Trade volume, nearby support and resistance levels, and the trend preceding the doji are significant factors that can either strengthen or weaken the significance of this pattern. Trade volume plays a critical role in confirming the doji pattern. A higher than average trade volume on the day the doji appears may indicate a stronger level of indecision and potential for a market reversal. It suggests that despite heavy trading, no clear direction could be established, highlighting the battle between buyers and sellers. Conversely, a doji that occurs on low trade volume might not hold as much significance, as it suggests a lack of participation in the market, and thus the indecision may not have as strong an impact on future market movements. Nearby support and resistance levels also add context to a doji pattern. If a doji forms near a strong support or resistance level, it could indicate that the market is testing but not yet breaking through these crucial areas. This scenario often strengthens the potential reversal signal because it shows that the market is indecisive even when nearing critical price levels. For instance, a doji near resistance could signal that an uptrend is losing momentum, whereas a doji near support might indicate a downtrend's weakness. The trend preceding the doji is equally important in assessing its significance. A doji that appears during an uptrend might suggest that the buyers are losing control and a possible reversal to a downtrend may occur. Alternatively, a doji during a downtrend could indicate that sellers are losing momentum, potentially leading to a reversal to an uptrend. The contrast between the trend before the doji and the indecision represented by the doji itself can provide valuable insights into potential market shifts. In summary, while a doji symbolizes market indecision, the context provided by trade volume, support and resistance levels, and the prevailing trend can help traders determine whether this indecision is likely to result in a significant market reversal or continuation. Together, these indicators provide a more comprehensive view of the market, allowing for more informed trading decisions. The doji is a candlestick pattern that represents indecision in the market. It is characterized by its thin body, indicating that the opening and closing prices are almost equal. Throughout history, the doji has been observed as a reliable indicator of potential market shifts, yet its predictive ability is not absolute. There have been situations where the doji accurately signaled a reversal in market trends. For instance, when appearing at the peak of an uptrend, a doji can indicate that buying pressure is diminishing, hinting at a possible trend reversal to the downside. Conversely, a doji seen at the bottom of a downtrend may suggest that selling pressure is easing, pointing towards a rally or upward reversal. However, the reliability of the doji as a standalone indicator can be limited. There have been times when a market seems indecisive as indicated by a doji, yet the anticipated reversal does not materialize, and the trend continues its previous direction. This is because the doji signifies market indecision, but it does not guarantee a change in direction. Acknowledging these limitations is crucial. To enhance the effectiveness of the doji in predicting market movements, it is advised to use it alongside other indicators. Combining the doji with trend lines, moving averages, or momentum indicators can provide a clearer view of the market's direction and strength. This multi-faceted approach not only lends more confidence to potential reversals signaled by the doji, but also helps in identifying more robust trading opportunities with a higher probability of success. In summary, while the doji is a valuable tool in identifying moments of indecision within the markets, its predictions are not infallible. By employing the doji in conjunction with other technical analysis tools, traders can achieve a more comprehensive understanding of market dynamics and make more informed decisions. Integrating the Doji Candlestick with other technical analysis tools offers a more robust approach to understanding market conditions. The doji represents indecision in the market, characterized by its small body indicating that the opening and closing prices are nearly identical. Let us explore how to combine this with other analytical tools for improved insight. One effective combination involves the use of the Relative Strength Index, known as RSI. The RSI measures the speed and change of price movements. When a doji forms and the RSI is below 30, it may suggest that the market is oversold and could be nearing a turning point. Conversely, a doji accompanied by an RSI above 70 might indicate an overbought market, signaling potential for a downturn. Another powerful tool is the Moving Average Convergence Divergence, or MACD. This tool tracks momentum and trend direction over time by illustrating the relationship between two moving averages of a security's price. A doji candlestick occurring while the MACD lines cross can provide insight into potential trend reversals. For example, if a doji appears as the MACD line crosses above the signal line, it may suggest the beginning of an upward trend. Bollinger Bands are also highly complementary to the doji. These bands expand and contract based on market volatility and encase the price action on a chart. A doji that forms near the upper Bollinger Band might hint at an overextended market, suggesting a possible pullback. Similarly, a doji near the lower band could indicate that selling pressure is exhausting, potentially leading to a rebound. By incorporating the doji with tools like the RSI, MACD, and Bollinger Bands, traders can obtain a more comprehensive analysis of market sentiment, momentum, and potential reversal points. This integrated approach allows for a nuanced perspective, crucial for making informed trading decisions in volatile markets. One common pitfall traders encounter when interpreting the doji is viewing it as an immediate signal for a market reversal without considering the broader context. The doji represents market indecision, but it doesn't necessarily indicate a definitive shift in market direction on its own. Traders can avoid this mistake by looking for confirmation in subsequent candlesticks or considering other technical indicators. Another misconception is ignoring the volume during the formation of a doji. Volume plays a crucial role in validating the indecision suggested by a doji. A high trading volume accompanying a doji can strengthen the signal of potential market reversal or pause, whereas a low volume might suggest a lack of conviction among traders, weakening the significance of the doji pattern. Traders sometimes misinterpret the doji by considering all doji patterns to be identical in implication. However, there are several types of doji candlesticks like the long-legged doji, dragonfly doji, and gravestone doji, each with its unique market indication. It is essential to recognize these variations and understand their specific contexts and implications. To enhance analysis skills and avoid these mistakes, traders should combine the doji signals with other technical analysis tools such as trend lines, moving averages, and resistance levels for a more comprehensive market analysis. Wait for confirmation from the market following the appearance of a doji, which could come from the next one or two candlesticks or a recognizable shift in market volume. Educate themselves on the different types of doji patterns and practice identifying them in different market conditions to understand their nuances better. Keep in mind the prevailing market trend and the position of the doji within this trend, as the same doji pattern can imply different outcomes depending on whether it appears in a bull or bear market. By considering these aspects, traders can improve their interpretation of the doji and make more informed trading decisions. The doji is a type of candlestick pattern that is often used in the analysis of financial market trading charts. The appearance of a doji signifies indecision among traders about the future direction of the market. It is characterized by its unique shape. The opening and closing prices are virtually the same, creating a cross or plus sign appearance. This pattern suggests that neither buyers nor sellers could gain control and signifies a potential turning point in the market. When using the doji in making trading decisions, traders often look for confirmation before acting. One common strategy is to wait for the next candle after the doji to close, indicating market direction. If the following candlestick closes higher, it could suggest an upcoming bullish trend, making it a potential entry point for a long position. Conversely, if the next candlestick closes lower, it might indicate a bearish trend, potentially flagging an exit point or a short position entry. Setting entry and exit points based on the doji involves careful consideration of additional technical indicators or patterns for confirmation. Traders might look at trend lines, volume, and other technical analysis tools to decide on the strength of the signal provided by the doji. There are stories of traders who have successfully leveraged the doji in their strategies. For example, a trader might notice a doji form at the top of an uptrend and then see confirmation of a trend reversal with the next few candlesticks showing a clear downtrend. Acting on this pattern, the trader could decide to exit their long position at the close of the doji or upon confirmation of the reversal, potentially saving themselves from a significant downturn. Another case might involve a doji appearing during a prolonged downtrend, suggesting a potential reversal. Upon waiting for confirmation and noticing the uptrend start, a trader could enter a long position, capitalizing on the early stages of a market recovery. It is crucial for traders to note that while the doji can provide valuable signals, it should not be used in isolation. Reliable trading decisions often require confirmation from other analysis techniques, taking into consideration the broader market context. The doji is a commonly observed pattern in candlestick charting used in market analysis, indicative of indecision among traders regarding the market's direction. A classic Doji candlestick is characterized by its plus sign appearance, showcasing that the opening and closing prices are virtually identical. However, there are variations of the doji, each with unique implications for market sentiment. One such variation is the long-legged doji. It features long upper and lower shadows that exceed the length found in a typical doji, reflecting a significant fluctuation in price within the trading period but closing near the opening value. This variation suggests a high level of uncertainty and indecision in the market as prices move significantly in both directions but close near the opening price. Another variation is the dragonfly doji, which has a long lower shadow and no upper shadow, resembling a T. This pattern occurs when the opening, closing, and high prices are roughly the same, with the day's low significantly lower. The dragonfly doji is often interpreted as a bullish reversal indicator, especially when appearing after a downtrend. It signifies that selling pressure may be diminishing and a potential upward move could follow. The gravestone doji is essentially the inverse of the dragonfly doji, with a long upper shadow and no lower shadow, giving it an inverted T-shape. This pattern forms when the opening, low, and closing prices are in close proximity, with the high price significantly above them. It is typically seen as a bearish reversal indicator, suggesting that buying pressure during the session was overcome by selling pressure by the end, possibly leading to a price decline. Each of these variations of the doji candlestick offers distinct insights into the market's mood. While the classic doji signals general indecision, the long-legged doji indicates extreme uncertainty. The dragonfly doji hints at potential bullish momentum, and the gravestone doji points to possible bearish reversal. Understanding these nuances can provide traders with deeper insights into market dynamics and assist in making more informed trading decisions.